What is the Federal Reserve's next move, and what is the likely impact on markets and gold? Gary Wagner, editor of thegoldforecast.com, joins us today. Gary, welcome back to the show.
Thanks so much for having me. Great to be here.
Last time we spoke was the day before the Federal Reserve meeting, the FOMC meeting to be exact, and we had talked about what they would do. The consensus back then is exactly in line with what the Fed did do, which is a 25 basis point rate hike. Last week, the PCE data came out harder than expected at 4.7% core PCE. And right the moment it came out, there was, I think, close to a 66% chance of one rate hike by June. And so what happened over the last week, you think traders forgot about the inflation data where that's no longer a concern?
Well, really, I think what happened is we had a very, very important speech by Chairman Powell, who said that he thinks it's time that we can look at a pause. And so that put some real strong optimism by market participants that in fact would happen. About a week and a half ago, we had 2 or 3 hawkish members of the Federal Reserve come out and say, we're not done raising rates. And that, of course, sent a flurry of concern. And that's when we saw that oscillation. And that lasted up until recent comments. The inflation data that came out Friday, of course, was alarming because it really, they're doing everything that they can, of course, not that they can, but they're doing everything in terms of a restrictive monetary policy to contract the economy, and yet consumer spending continues to be robust. And that was kind of a quagmire for the Fed. It was kind of 2 steps forward and 2 steps back. And so that got people concerned that, well, maybe they're not. The term I read was they're going to do what's called a hop. In other words, they're going to do a pause now, give it a couple of months, see what happens, and then if needed, start another series of rate hikes. If not, maintain the elevated level they're at now.
The priority, of course, for the Federal Reserve is to maintain a low level of unemployment as well as to bring back inflation to its 2% target. But keep in mind that if we have a recession, the unemployment rate is going to go up. And so if they keep rates elevated, that raises the chance of a recession. And so my question is, what is their priority right now? Fighting inflation or preventing a recession?
I think their priority is to keep inflation in check. And I think that they've been too heavy-handed personally. First of all, they were late to the party. They started raising rates March 2022. Inflation was already well above 8%. And so by doing that, they have been reactive rather than proactive from that moment forward. I think that the aggressiveness that they've had of every single FOMC meeting to have it conclude with another rate hike, 10 in a row. This would be the 11th meeting since they began, and the first one in which they didn't raise rates. And so what you brought up is an excellent point, and that is that there are components of inflationary pressures that are going to remain constant, sticky, persistent. And the second thing I'll add is that their target of 2%, many, including myself, do not believe that that's achievable or realistic. So they're focused on getting inflation down. That's their number one priority, but it's their target, I think, that's kind of out of whack with reality.
Suppose the Federal Reserve raises interest rates one more time, or the Fed funds rate one more time in a couple weeks because of whatever data they looked at last minute. What do you think is going to happen to, first of all, the stock markets and then gold as a response?
The question you're addressing is the upcoming FOMC meeting rather than a pause or hike. I think that market participants have, for the vast majority, really factored in a pause. And all of the moves, the upside move you've seen in equities, the upside move you've seen in gold, is predicated on the fact that they're not going to raise rates. If they did raise rates, you would see an unwinding of the gains in gold. You would see an unwinding of the gains in U.S. equities. It would have to refactor in the new piece of news.
If a client of yours were to ask you, what are the major risks that I have to be looking out for this year, given everything we've discussed, what would you say?
Well, what I would say is that it's a scenario in which there are market forces moving that are bullish influencers and bearish. In other words, inflation is something that traditionally will be highly supportive of higher gold pricing, but interest rates being elevated does the opposite. So anytime yields go up in US debt instruments, what the short-term bills were, or 1 month bills in terms of maturity, were at 6% just prior to the resolution of the debt ceiling crisis. It doesn't make sense to move money into gold or a large percentage of your portfolio when fixed incomes are doing exceedingly well with less risk. And so that's what I really want to hone down for anyone who's a gold or silver investor. But long term, I think that it's always going to maintain a certain value. It's all going to be pegged on the dollar. The dollar's been so exceedingly strong. And we talked about this last time, and that is when we say dollar strength, we're not talking about the buying power. The buying power has been diminishing year after year, month after month. It's when you compare it to the basket of foreign currencies it's trading against. So who's doing the worst job? And so it's the thing to be sensitive to and to be cautious about is where the dollar goes relative to the dollar index.
Very good. So let's talk about the dollar now. The key forces of the dollar, besides interest rates, the strength of the U.S. economy. Let's factor these macro forces together and give your projection for the dollar for the rest of the year.
My sense is we traded to a high recently, I'd have to look at a chart, I think maybe 4 to 6 months ago of around 114 on the dollar index. It came back down and traded to about 100.50 on the index. And then it began to move up. And this is the recent move from about 100.50 to about 103 to 104. So I think that we could easily see if the dollar has topped out on a short-term basis, which is my assumption right now, because as these issues get resolved, the debt ceiling and elevated interest rates, yields are going to begin to come down. And as yields come down, the interest in the dollar or the dollar strength diminishes kind of in tandem with that. So that's what I'd be looking for, maybe a retest of 100, which is about 2% from here.
And I guess that would impact the gold price as well because they're usually directly inversely correlated. What I've noticed is that since 2020, the gold price has not quite perfectly, but almost tracked the S&P 500 or major stock market indices. In 2020, right after the pandemic, we saw a rebound in equities and a rebound in gold as quantitative easing pushed up both asset classes. All throughout 2021, that was a divergence, so the stock market continued to go up while the gold price trailed lower. The gold price continued to fall in 2022 alongside stocks, and of course both asset classes, risk assets and gold, rose dramatically since the second half of the year last year. Is this something that is merely a coincidence, or are they both reacting to, I guess, external forces that are moving both in the same direction?
Typically, there's an inverse relationship. That's why we say market participants have moved capital from risk on to safe haven. Safe haven, they've liquidated that to move it into the equity. So there's that inverse correlation. It's liquidity theory. You're moving your money to where you think you've got the best return with safety. If you look at what happened, say, between 2009 and 2011 and 12, the exact same thing occurred, David, because when you have quantitative easing by the Federal Reserve, where they're pumping huge amounts of cash into the market, they're devaluing the dollar, that is good for gold. It's also the cheap money is good for US equity. So we saw the same divergence happening where in 2009, 2010, up to the record top, which was in the middle of 2011 in gold at 1900 or 1910. Then gold started coming down, but US equities kept going up. And I wouldn't be surprised if we saw something similar to that because it's predicated on money supply the tightness or looseness or availability of credit and rates. And so those are the times when you get equities and gold moving in tandem, is when the Fed is heavy-handed in terms of monetary policy.
So it's not that gold has not been reacting as or acting as a safe haven asset in the sense that it's hedging against equities. It's just that, like you said, you got the Federal Reserve and their invisible hand of monetary policy playing with both asset classes. So my question is, what do you think is going to happen to this correlation this year? Will we continue to see them both trading in tandem, or do you think this correlation is going to break down?
It depends on if the Federal Reserve keeps rates, as they said, elevated throughout the rest of the year. We're halfway through the year. If they do that, that is going to be a defensive mechanism for equities and gold. It's going to give it a bearish influence. High rates really is something that's a killer for stocks moving higher as well as gold moving higher. What tends to happen is if they start cutting rates and inflation remains persistent, because my sense is that no matter what they do, there's certain components that the Federal Reserve can't control. And the ones they can't are the ones that are omitted from their inflation indexes. And that's why they use the PCE core index, because they can't control energy, they can't control the cost of food, and they can't control housing. Now, housing, a little bit they can crash that market because they can make mortgages unobtainable. But those are forces that the tools of the Federal Reserve, which is monetary aggressiveness, interest rate hikes that are aggressive, as well as credit tightening, those are things they can control, but it's not going to change the price of wholesale foods. Now, manufacturing is a different issue. As you said, we've seen a contraction for 7 straight months. A report came out, what was it, Friday? And so you have components of the economy that are definitely reacting to the heavy-handedness of the Federal Reserve. On the other hand, you have such things as grains, food as a whole continuing to be elevated. So the question is, will the Federal Reserve continue to act with a heavy hand and think that they can achieve a 2% target of inflation? And maybe they can. But in this environment, I'm hard pressed to believe that that's going to be easily achievable. And if it is achieved, how much pain is going to be a byproduct in terms of what it does to North American individuals that are just trying to work and support their families and keep themselves above water.
Gary, have you noticed ever or observed an inverse relationship between consumer sentiment and gold? I'm taking a look at the University of Michigan Consumer Sentiment Index, for example. There's a few different indices measuring consumer sentiment. The Michigan one is just one of them. But if you take a look at the last couple of years, for example, there are periods in which they've moved, gold and consumer sentiment have moved in opposite directions. Now, I wonder if this is somewhat linked to the markets, in the sense that if consumer sentiment is low, they anticipate markets to be weak, or the economy to be weak, and markets a reflection of that, and then the gold price to rally as a result. Does this make any sense?
It's a very interesting question. I haven't done much in terms of trying to ponder a correlation. When you talk about consumer spending, what pops in my head is the amount of capital that was allocated during the pandemic and the recession, and the fact that consumers really started to spend aggressively. From what I have read recently, consumer spending went up 0.8% last month. Income only rose 0.4%. So they're making a little bit more, but they're spending a lot more. And it's showing that there's a huge amount of debt on credit cards. It's, I think, $1 trillion plus, or I'm not sure of the number, but it's a very large amount. And it's troublesome and worrisome to a lot of economists that consumers continue to spend. I think it began as an offshoot of all of the financial programs that were available to people to get us out of the recession. And so they continue to spend at not an alarming rate, but they're doing the same thing the government's doing. They're spending more money than they really have available. And although the government can print money, individuals can't. Not only that, if someone gets into any large amount of credit card debt because of the loan shark rates those guys charge, you're 15 to 20%. I mean, that's ridiculous. That's going to tie their hands. So that's what I look at. I don't really see a correlation between consumer spending and consumer sentiment and gold that much. It's something I've missed in terms of picking up on it.
Just because something has a correlation, even in the short term, doesn't mean there's a causation. So it's just something interesting I've observed. Certainly, the logic makes sense, but your analysis makes it clear. But I wonder what the primary drivers of gold this year are.
In the big picture, and this is what we talked about pre-show, is the fact that gold, once interest rates starting to, once the Federal Reserve began to raise rates from near zero to a quarter basis point, March of 2022, we saw a huge decline from 2,085 per ounce down to these lows in November of about 1,600. I think it was $1,620. That's a tremendous price decline. But I believe at that point there was a false narrative or unrealistic optimism that the Fed had to cut rates, and they didn't. And when that realization sank in, that's when we saw gold move back up. I believe that now market sentiment is closer in tandem to what the Federal Reserve says they're going to do, whether they do it or not, and they're data dependent. I think that a pause has been necessary for some time, but the fact that it's actually possibly going to occur this month is a positive sign. I think that the answer to our economic woes are not restrictive monetary policies, but a robust GDP. That the only way you're going to get this country out of debt or have the GDP to debt ratio get into alignment is by boosting up the GDP, not by contracting the economy. And so to me, it's an interesting fact that, yes, we need to focus on inflation. I mean, that's absolutely essential. Had they done it right when inflation was at 2% in 2021, instead of waiting a year and letting it go up to 8%, of course, they did that because inflation was transitory and it was just going to take care of itself. They wouldn't be in a reactive mode. And so they had to be heavy-handed, yes, but there's a price that we're paying for it. And the people paying for it are everyday Canadians and Americans, North Americans. And so I think that the real answer is to really get the GDP working on all cylinders. And now the government's taking in larger bases of revenues. The GDP to debt ratio is going to work itself out just as a byproduct of that, rather than contracting the economy that has the opposite effect. And so, yes, they're single-minded about inflation, but I don't think, listen, these guys are much smarter than me, but I find it hard to comprehend that they're not looking at the end game as an end game of, if you want to get debt and income into some sort of a balance, the most logical pursuit would be to get income up rather than contract the economy, meaning get debt down. And that's my take on it anyways.
You could, to boost the economy, we have to raise the income. There's several ways to do that. Raising productivity, having larger population. Of course, then you're talking about GDP per capita.
Right. Or lower interest rates.
We're lowering interest rates. We had that for about 10 years.
Well, realize that before we got into this whole mess back in 2019 and 20, I think we had one of the longest periods of economic expansion in I forget, last 50 years. I don't know that it was in history, but it was like a 10-year period of just huge economic expansion year after year. And that all came to a grinding halt.
you don't think that, well, some people have said that this low interest rate environment we've seen for 10, 12 years has created economic bubbles never before seen. And it's partly responsible for asset bubbles that we've seen now and the correction that we've seen last year. Is there any, do you agree with that viewpoint that low interest rates are not normal, especially near the zero bound, and contribute to asset bubbles down the line?
I think that there should be a balance. In other words, having interest rates at near zero doesn't make much sense, but having them elevated at 5 or 6% doesn't either. To have it at 2 or 3% is a lot. I think that balance is the most important thing to consider. The key is that I believe the best way to build and to maintain economic growth is having a moderate interest rate and low inflation. Now, inflation is going to be a product of supply and demand anyway, so that we had pent up demand after everything happened in 2019 and 20 that led to a recession. I think that we need to get back to the steps we were taking pre-2019, when we had one of the largest expansions that has ever occurred in terms of the capital that the GDP was at. And I think that would be the way to focus on it. Now, to put all of the components of the government, all of the different bodies into a collective, an agreement on that would be very difficult, impossible at best. But I think ultimately, if we're going to dream of what is a solution that seems to be likely to work, it's not going to be getting inflation down by bringing the economy to a crawl and making mortgages. One of the primary drivers of the economic expansion was home prices being stable and moving higher, and people getting into those homes, first-time buyers, people moving up. And that stopped as soon as the Fed made mortgages sitting at 6 and 7%. It's quite different than where it was, where if you had good credit, you were able to get a 30-year mortgage at 2 or 3%. It's a big difference.
Yeah, that's a topic for a different discussion. Mortgage rates,
yes,
impacting everyone. Finally, I want to end on this note that the stock markets, especially the tech sector has been booming. Defying gravity, some people would say. I wonder if this is just a case of sell in May and go away, and people are complacent into the summer. Certainly, it's sunny where I am, weather-wise. I'd rather be outside than trading stocks. I don't know about most other people, but the point is the markets reacting to some sort of economic force? Are they expecting an economic recovery? Are they expecting the Federal Reserve to maybe even cut soon? That this rally that we've seen, it's unstoppable.
Well, I happen to think that the rally that we're witnessing, especially in the tech sector, is so intrinsically tied to AI, or the development of artificial intelligence. It's that we are moving into such a futuristic scenario in a timeline that I believe is happening quicker than I thought it would. But then the key right now is I don't think it's unrealistic that we're seeing the kinds of moves that we've seen in the tech sector. For example, what was that? NVIDIA doubled its market cap, went up 24% in one day or something.
Last week when earnings came out, yes.
Yeah, and that's market participants getting into alignment with what's been driving these equities higher. As you know, I've always said it's not a stock market, but a market of stocks, and the stocks to look at are the ones who have deep hands in the most advanced technology of its day. And I don't think that that's blown out of proportion. But then I'm not one you should ask, because when Google started getting popular, I thought to myself, well, how are they going to make any money? They just give away all these things for free. Little did I know they understood the value of data. I didn't. So I think that there's realistic components of the expansion and the higher stock prices in the tech sector.
Okay, very good. Gary, I appreciate your time. Thank you for your insights today.
Thanks as always for having me.
Thank you for being here. And thank you to the viewers for watching. I'm David Lynn. Stay tuned for more. Don't forget to subscribe.